Oh, it's really raining. Okay, so it's raining out there. Okay, so we were talking about stocks, bonds, and savings. Yeah, I know. So the first thing I want to do is talk about stocks. I have no idea. They sound awful to me. Yeah, so penny stocks. So so I wanted to discuss the whole concept of stocks, what the original concept was. I mean, stocks have been around. People have been investing in companies for a long time, like Jamestown. It was probably, I don't know what it was called, the Jamestown. There was some company. What was it called? East India Trading Company. Yes. Yeah.
I've done abbreviations, these for histogram, but like some of the.
Oh, and the Excel stuff. Yeah. Okay. Okay. What was it? Was it T? Yeah, that's what I was thinking. East India. I'm not sure what the. We'll have to figure it. Well, we'll do it. We'll do it. Is that what it was? Okay. So anyway, that was kind of a stock. That was a, people invested in that company because they had expectations of certain things being resources being available. I don't think that particular one was looking for gold, but a lot of them that went to the Americas were looking for gold, and they were hoping to, it was a risky thing because they hadn't found gold, but they'd heard people found gold, so. So I'm going to use this. I have kind of the story of the paper mill. It used to be called, well, a long time ago, it's called Westvaco, West Virginia Pulp. Before that was the West Virginia Pulp and Paper Company. But I have this website that I put together many years ago, and I haven't really done much with it, but it has a description of kind of how the company started. And it talks about stocks, so I thought I would show you that. So let me, if you ever want to look at it, you just have to go to Google and put in Stephen Nicholson Allegheny Highlands. Okay. And there it is. So let me share that. Got the Allegheny colors. That's it. And yeah, the whole story behind this is kind of interesting. So back when the internet was just starting out, AOL had this option to create web pages. They had a software called AOL Press, which was a actually pretty good way of creating web pages. You didn't have to really know HTML. You could program it kind of just like you would use Word or Publisher. But if you wanted to, you could see the code behind, you could see the HTML code behind it. So I thought, yeah, I'm going to play with that. What could I do? Hey, I'm going to make a website about the local stuff, and then I got carried away and got all kinds of stuff. There's, old pictures of Covington. There were people at Westvaco that had historical pictures of various things. I drove around and took pictures of things like the churches of the Allegheny Highlands. I did that. I drove around. I took pictures of the things, and the size of the images are pretty small because back then it was dial-up, and it took forever. It took upload and download it. So you'd be going so I ended up doing them to a reasonably small size. And I don't think I have the originals anymore. If I do, they're somewhere around. But I'll have to bring in my old camera. I had a Kodak digital camera that was about this cross section, about that long. And it was one of the first digital cameras that were reasonably priced that came out. So I took them with that. Anyway, one is just this stuff about Westvaco. And they put out a history of Westvaco, and I ended up using a scanner to change. I didn't type it all in. Optical character recognition, I did that, and then they were broken up into the years. And so this is the 1890s, history of Westvaco in the 1890s. It turned out, luckily, a lot of this stuff I put on this website called Free Pages History Roots Web, and then Ancestry.com bought it, and so they've maintained it. It was originally for a lot of genealogy stuff, but at the time you could pretty much do any kind of website you did, and that's been maintained. I had AOL, stuff on AOL, and that kind of disappeared. They didn't support web stuff anymore. So some of my links are dead, but luckily I did. Some of them were yeah, do I know where they are? That's right. So if you look through this history, the history of this particular company was, this family was originally from Scotland. In Scotland they had paper mills. Most of the time they made the paper out of rags, so it was cotton. They didn't use trees at the time for most cases. So they hadn't come up with the process of converting tree fibers and trees into paper. Of course, that's the way most of it's done these days. But before that, you used to have the rag man go around, and the reason they had rags was to use it to make paper because they're fibers, cotton fibers. So this guy came to the United States, and originally he was like a mill superintendent, so he was the boss, but then he decided, hey, I can start my own company, and he was well known enough in the industry that then people who said, hey, this guy's going to go out on his own and make a business. So they originally built a plant up in West Virginia, on the West Virginia-Maryland border. And so I'm just going to read a little bit from here. So the name selected for paper making operations was the West Virginia Paper Company, and it was incorporated in the state of West Virginia. The original subscribed capital for this company was $45,000. Members of the family were the only stockholders. And then they had a board of directors. So, they created a company. They actually invested in it, $45,000, which doesn't seem like that much, but back then it was worth a lot more. There's later on, they talk about other companies that were formed. This one was in Davis, West Virginia. They had come up with this new pulping process that worked specifically well with spruce trees. And there were this huge stand of spruce trees in Pocahontas County, West Virginia, which is where Cass is. Has anybody ever gone to Cass, gone to the railroad at Cass? Yeah. So that land was originally owned, well, not originally, but it was owned at some point by this company, and they specifically bought it because it was the spruce trees that they were doing. And it was a chemical process to separate the fibers from the stuff sticking it together. So they had a company that did that. There's somewhere in here. Let's see if I can find another. So there's all this stuff about Davis, West Virginia. Now here is, pardon me? Oh, that's where there used to be a paper mill in Davis, West Virginia, a long time ago. Oh, is it? Yeah. What's that? Yeah, Davis is, yeah. So that, yeah, actually there is, it's not there anymore. That paper mill didn't last that long, but So let's read this. By 1897, the companies under the Luke management had prospered and grown to a size that it was decided to consolidate them into one company. The West Virginia Pulp and Paper Company in West Virginia was organized to combine the three organizations into one corporation. It was now multi-million-dollar status with an authorized capital stock listed at $5 million. So, that back then, so over 10 years they go from maybe $30,000 in stock to $5 million in stock. And the whole idea there was that they were borrowing money to build stuff. They were buying land in West Virginia for the forest. They were building these pulp mills and paper mills in different locations, and ultimately they ended up building one here in Covington. And then at some point, right now it's really just still a private company with stocks sold into it. At some point, I'm not sure when it actually became a public company, but at that point you're selling the stock to people, more than just a few people, and then you put it on the stock market, and then people can trade it and sell it. So here's a little interesting sidelight. The Lukes started exploring sites for a pulp and paper operation along the Greenbrier River. The main east-west line of the Chesapeake and Ohio Railroad ran through Ronceverte, West Virginia, and was being extended by the branch line which went north to Pocahontas County. Since all pulp mill wastes at the time were dumped into the river, the question of pollution arose regarding the future site of the mill, and there were fears raised that the farm people in the rich Greenbrier Valley would protest any river pollution. As the original Piedmont operations, which is in northern West Virginia, as the original Piedmont operations were being expanded, citizens of Cumberland, Maryland were already threatening the company with a lawsuit over river pollution. So the Lukes decided to move the mill into Virginia on the Jackson River at Covington. Here the river was already polluted, so the addition of the pulp mill would not significantly affect the water quality. And it said also once the spruce trees were placed on rail cars and cast, there was very little difference in the freight rates if the final destination was Covington or Caldwell. So it turned out, and then later on it turned out Covington, because they changed from spruce to other trees because they were running out of spruce, it turned out that it was the more advantageous site in the long run. But the original reason they came to Covington was because the river was already polluted. They had iron furnaces, they had a tannery, and so what's an additional, it's already polluted anyway, so what's a little extra pollution? So that was the reason it's here instead of in West Virginia. Anyway, so that's the original idea of stock. There you can see how much the company's growing. They're reinvesting it. So there's people who own stock, which maybe was originally worth $30,000, is now worth hundreds of thousands of dollars, and you're making a pretty good return on your investment. And if for some reason even if the company was poorly managed because of the people, somebody would probably say, hey, the equipment's still good, I'm going to buy the paper mill. And so there would be still some assets even if they went bankrupt for poor management. Okay, so that's the way stocks are. Now, the way stocks are now, it's somewhat different. So let's use Facebook as an example. I'm not an expert in the history of Facebook, but this is my so this is kind of a summary. This is the old way: selling shares in stock, building paper mills, having equipment. Once you had profits from the company, you would give some of that profits to the shareholders as dividends. You would trade the shares. The value of the shares may go up. And basically, so you're both getting reward from the dividends, also the anticipated future value of the stock price is going up. Nowadays, what you have is you have this situation where you have people that have a lot of money, and they're trying to make more money, And so, and not everybody who's rich does this, but there's enough of them. They're called venture capitalists. And the concept is that they look for businesses, small businesses, or concepts like the Shark Tank. You know, they're like, hey, you know, do we want to invest in this thing? And so they put some of their own personal money into, or these funds that are consist of money from rich people that they pull together, and they pick businesses that they think are going to be successful. Now, what's the percentage of businesses that actually start that are successful? I don't know what the number is, but it's not big. It's, you know, probably less than 50%, probably even lower than that. Yeah, but it's enough that people still want to invest their money in these kinds of situations. So you build a business. So let's use Facebook for an example. You know, originally it was this guy building a company, or you know, it was originally just for colleges. It was this platform for providing social interaction between people in a particular college or colleges, meeting people. And so, you know, then started to grow. Originally, I don't know how they got revenue. You might have just, they may not have any revenue except venture capitalists thinking that this is a good idea. And then they expanded to other people besides universities or colleges, to high schools, and then to regular people. And then they had to figure out a way of making money. So they figure out a way of trying to monetize the idea. And then when they get to a point where they think it's attractive enough to the general public, then they'll have an initial public offering for the stock. And then that's the point where the original investors get their reward. But it's not that people are not investing in Facebook so they can buy more computers. They don't need that. It's more a way of rewarding the initial investors and maybe possibly letting more people in to being part owners of the company. Okay. Yeah. Yeah. So, you know, another example is Uber. A lot of times these days you get initial public offerings where the companies have not even made any money yet. They're still not making a profit. So it's very risky and speculative in some sense. So the latest big initial public offering was Snap Incorporated, which is the company that does Snapchat. And I have this cynical view that nowadays when people do an initial public offering is when they think that it's reached its peak and they want to cash in before it's exposed as a as a flash in the pan kind of thing, because the value that some of these companies get in their initial public offerings, value meaning the number of shares times the stock price, is huge for what they're not even making any money yet, and they don't know how they're going to make money. But it's somewhat, yeah, it's kind of more speculative. And if Snap shut down, if their market value is $40 billion, they don't have $40 billion in assets or company. They don't have in land or equipment, and so the downside is much greater. I don't know how Snapchat. Does that? They have ads. The question is, you know, the more ads you have, the less attractive it becomes. Yeah, yeah, yeah. So here's the question, and one question some people ask, is the stock market like gambling? And why would I say, is the stock market like gambling? What is gambling? Yeah, you're playing a game, maybe, or somebody's playing a game and you're betting on it. And there's an element of chance. There may be some, if you're betting on sports, it's not your skill, it's somebody else's skill that you're betting on. They usually create odds so that if you were betting on the Browns versus the New England Patriots, everybody bet on if it was even odds, everybody would bet on the Patriots, and nobody would make any money. So they come up with odds to try to make it so that whoever's doing that game is going to ultimately win. Otherwise, they're not going to do it in the future. You lose your shirt, you're not going to. You have to have some benefit. So why, when it comes down to the stock market, the question is, can somebody predict with skill what's going to happen to the stock market? And we were talking about that the other day, and the answer is no, not in general, not.
But that's sort of misleading because you can, on average, yield.
Yeah, you count an average. Yeah, but why is that? Because ultimately, why do you buy stocks? You buy stocks for the anticipated future value and for the dividends. And the question is, how do you predict what you might have some idea of dividends based on the profitability of the company, and there are things that you can do that, but the anticipated future value, a lot of times they're not related to the actual behavior of the company. It's the behavior of the economy in general. So that's so some people might consider the stock market as gambling to some extent. So I'm sort of in that camp, but yeah, like rolling dice or something like that. It's not exactly. Okay, I'm going to show you something. Let's see here, stock market. Yeah. So what I did was I went online. I was hoping to find an Excel sheet that had the return on stocks, and I didn't have to do this, but I ended up entering the data myself. So right now we're just concentrating on the first two columns. And what you see in the second column, first column is the year, and the second column is the average returns for the year for the stock market. So back in this is for 100 years, 1916, on average, stocks lost 4.2%. 1917, they lost 21.7%. What was happening in 1917? Yeah, it was World War I. That was when the Americans entered World War I, so it's probably a pessimistic view of things at that particular point. They didn't know if it might have been that. It could be, yeah. And then the war is over, and everybody's excited about it. So the next 2 years, the stock is up pretty strong. Then 1920 something happens, and it goes the other direction, about the same amount. That was probably, well, I don't know what it was, but a lot of times these changes are related to political and global economic situations. What's that? Yeah, I don't remember when Prohibition was. So if we go along, what's the next bad thing that happens? The Great Depression. So you can see right just before the Great Depression, everybody was excited, 49.5% in 1928, and then the stock market crashed, and for 4 consecutive years, it lost money. So let's say you had $20,000 or $30,000 after the boom. By the time you finished, you only had $6,000 left. So you lost almost 80% of the value of your stocks. That's not good. You have $100, you only have $20 left. Okay. Then 1933, it went up 66%. So that recouped about 2 years worth of loss. So if you sold your stocks here and kept your money until there and then bought stocks, you'd be making a huge amount. What most people did was probably the exact opposite, but we'll talk about that. As we go along, there's ups and downs, really high years, 28% plus, 32% minus. And most recently, we'll go all the way up here to 2000-ish time frame. The late 1990s were real, 1995 to almost 2000. The stock market was doing very well. And then for 3 consecutive years, they lost money. Now that was due to the dot-com bust. That was back when the internet seemed like a good idea, but it was really too early for businesses to viably use that mode. I had a friend from college, actually the guy who's my best man at my wedding, and he was originally a consultant for a company called McKinsey, which is one of the top consulting firms, and he used to work on mergers and acquisitions in Japan. So the late 1990s, he moved back to the United States and started working for one of these internet companies. It was some company where the stuff that was returned, that people bought but then returned, would resell, and then it went bust. So they went back to consulting again. But so there was an extended period where it wasn't so good, and then people were like, okay, we're over that. We got some pretty good years, and then we had 2008, which is where we got closest to another depression, when the housing market collapsed and banks closed and all those kinds of things. So we lost 34% of its value in 1 year. So that's what volatility means. At the end of it, yeah, if you knew when the end was, that's the problem. That's probably where Warren Buffett makes his money, is doing it where, so anyway, you lose that money and then it comes back. You can see the carnage of the Obama years here. What's that? American carnage. Yeah, this is the American carnage here, where things went to hell in the handbasket, which is a facetious statement, because the stock market was, except for 1 year, 2015, was positive through all those years. And part of it was just recovering from this particular situation. Okay, so anyway, the purpose there was just to point out some historical cases where you had massive direction in both directions. So I had this thought, because I've always heard this, that the stock market on average gains 13% or something. So what I did was these other columns is I put in $10,000 in certain years, and then I figured out what the final value would be in 2016. So if I put $10,000 in the bank in 1916, based on these yearly returns, which is easy to do, it's just simple interest kind of calculations. How much money would I have in 2016? So $10,000 in 1916 would be $1,680,552. Pardon me? Well, this was in 2008. Yeah, that was, well, yeah. Actually, yeah, there was in the 70s. The stock market didn't do very well. We'll look at that in another graph in just a second. At first, that seems like, hey, that's pretty good. But you can also do a simple calculation. I want to do it for this one. What you do is you take the ratio of the value, the present value, you divide by the initial value. You raise that to the power, but you take 1 divided by the number of years, which is 100 years. So I'm just going to put 100 in there. And that'll give you your effective yearly return on investment. So it's kind of the opposite of taking t times 1 plus the interest rate to the power. You take the root, and it comes out to be 5.2%. So just putting $10,000 in a savings account at 5.2% would give you the same result at the end, which is $1.68 million. So it's not that impressive. It looks impressive when you compare of $1.68 million versus $10,000. But from a yearly standpoint, it's only 5.2% per year. And I did that for various starting times. So if I go all the way over here, if I put $10,000 in 2010, I'd have $16,711 now, which is about 9% per year. If I put $10,000 in the year 2000, I would have, I only got 2.6% per year, which is not that great. And if I did it in 1990, I got 7%. In 1980, 8.6%. None of those numbers are near 11%. I'm looking at the digits here, 6.8, 8.6. And I thought, why is that? Why are my numbers less than people quote all the time? Are they lying or am I missing something? Pardon me? So the one thing I didn't take into account is the value of stock is, there's two components. One is the stock market price, and the second one is the dividends that you reinvest. So let's say I have $1,000 of stock and I get 10% dividends that year, which is probably too high, but it's an easy calculation. My value in the second year is I'm going to earn $1,100 worth of stock because I'm going to take that dividends that I get, I'm going to put it back in and buy more stock. So when you combine both the dividends and the increase in stock price, you end up with something that's closer to 11%. I haven't had a chance to actually go back, and I think there's some data that shows you by year how much value you get from the dividend part and how much you get from the stock price. Now, a lot of companies like Apple, I don't think, used to not give any dividends, so their value is entirely based on stock price increasing. But then there are other companies that maybe stock price didn't increase as much, but they gave a more substantial dividend, and both of those impact what the return on your investment is. So if you remember back when we did the spreadsheet on trying to figure out whether we could retire or not, we used 6%. And so that's not even if you didn't consider dividends, you would say that's a reasonable number because, 5.4, 5.8, 6.8, 8.6, so forth. And with dividends, the 6% return is not unrealistic. But it's very dependent upon when you make the investment. Here I'm only getting 2.6%. Here I'm getting 8.9%. So the advice people give is you just do a certain amount each year, and that will even out the ups and downs, and then you'll ultimately get more of just the average. So that's why when you have an investment program with your company, you do it all the time, and that way that kind of spreads out these ups and downs. You just have to take a deep breath and hope that things work out. So like in 2008, my wife had this stock. It was a growth fund. Growth funds tend to grow more quickly, but they also tend to take a dive more quickly. And so yeah. I saw you there. Why were you standing there anyway? I was trying to figure out what was going on. Oh, were you? Okay. So I thought you were just contemplating life or something. So, yeah. Okay. So, so my wife had this money that she'd inherited. So she's like, I'm just going to put it in some long-term thing. And then that happened, and she got the statement that said, your value is now 50% what it was originally. And she was like, oh, I'm going to sell. I'll lose all this money. I won't have any money. And I was like, don't. You just got to take don't worry about it. It wasn't a huge super amount. It was just because it was some inherited from her aunt or something like that. So she So, so anyway, what she did was she waited till it got back to its original value and then sold it. She didn't. She was like, I don't want to deal with that anymore. You've got to kind of have a tolerance level and belief that, yeah, like an internet connection. Don't watch the news and all those kind of things, so you don't react. You know, Tucker's got to go somewhere too. He's not just, yeah. Okay. See ya. No, just kidding. Okay. So let's just go back to the internet here, and what's that? Yeah. Yeah. You should actually be able to. You should be able to. Um, if you save it as an Excel file, you should be upload it to. You lost the data. Okay. Okay. Yeah, but your work. And this is from which you were doing it where? Excel or yeah, and you saved it? Okay, well I'll look at it after class. Okay. So most people don't buy individual stocks, so I was just going to talk about mutual funds.
So we're talking about various financial instruments. It was like we're playing in a band. The attendance question for this lecture is to go onto Google and search under Roth IRA Wikipedia. And so the question is, what state did Mr. Roth represent in Congress? So it was named after this one guy named Roth, and then the other one was Packwood, I think. So anyway, just look under history, Roth IRA history, inside this Wikipedia entry.
So this is U.S. News and World Report, and they rank mutual funds. And so what mutual funds are just a collection of stocks from different companies, and typically they are characterized by a certain investment philosophy or type of company. So you can see here they said popular rankings. So you've got bond funds, which are not stocks. We'll look at those in a minute. You've got things like small growth, large growth. Small is not it's a small company that's a growth company. You wouldn't want small growth because that's not going to make it. It's like, yeah, it's like poor. I'd like all companies with no profit. Who would do that? So small growth just means small size. Large growth means large companies. There's a growth company, and a growth company is a newer company that typically doesn't give a lot of dividends. They're using that dividends to theoretically expand the company. That isn't always necessarily true. They may just put the money in a bank account and have a lot of cash sitting around, but that's when it is true. Yeah. So you're reinvesting back in. At some point, once it might change from a growth to what they call a value. What that usually is this large means it's a large company like Microsoft or General Electric or GM. And value usually means that there are reasonable dividends associated with it. Mid-cap, cap stands for capitalization. So that's the small cap, there's mid-cap. Mid-cap would be, just the capitalization is kind of how big they are, how much money they've invested. Technology, you'd expect Sun and Intel and Microsoft and all those technology companies, or health, pharmaceuticals. There's also this target date retirement, which I'm going to talk about. So I'm just going to look at a few of these categories just to kind of give you an idea of what they are and why you might choose to pick a mutual fund that is in one of these categories, or why you might choose a few. So I'm going to pick Vanguard. And so these all have the same kind of information. And the things that we're interested in is the performance, for one thing. How well has it been doing? So one way of doing this is to look at the hypothetical growth of the $10,000 investment since the opening of the stock. The one I'm just going to look at here is these returns. So you can have it on a longer time frame than this, but they're saying this is just the abbreviation for the company or for the stock, Vanguard something. So it's made 2.8 or about 3% in the month, 10% in 3 months, 9% in 6 months, 23% a year. So that's pretty good for a yearly growth. And then typically they have for the fund, for 5 years for maybe the length of the fund to give you an idea. So the larger this number, the better. That's how they get ranked. This is a kind of a comparison. This is Standard & Poor's 500. That's a 500 companies that are grouped together as an aggregate. So this, if you have an index fund, somebody might have an index fund that just follows the Standard & Poor's 500 companies. That's 20%. So it's doing better than if you just bought an index type fund. In the category for large growth, the average is 15%, which is lower than the market. So this guy's better, but then again, why is he better? Has he just got lucky? Some people are going to get lucky and some people unlucky if it was completely random, if monkeys work for these companies. So you don't know whether it's luck or whether it's skill. That's one thing you have to okay. And then you look at the holdings. This is the companies that they're invested in. First thing to do is they talk about the percent of the different kinds of investments. So let's just look at those. Cash is money available to buy stock when they need it, okay? Because you either have to sell stock to buy stock or you'd have to have money to buy stock. When it just says stocks, that means it's domestic stocks. So 81% of their investments are in domestic stocks, 13% are in foreign stocks. So it's all stocks. There's no bonds. It's a reasonably high cash from what I mean, I'm not an expert, but what I've looked at. So typically growth funds also are heavier into stocks, but they tend to be ones that they expect the value to grow, and then you can come down here and find exactly what they're investing in. So you've got Amgen, Southwestern Airlines, Eli Lilly. That's a pharmaceutical company. What's that? Is it? So you got banks, Microsoft, FedEx, CarMax. A lot of companies you've heard of, some of them you haven't heard of. So that's one example of a growth fund. Let's go back and look at a different kind of fund. So we'll look at a large value instead of a large growth. Here's another Vanguard. I'll choose something different so it's not the same one, same company. So I don't show any favoritism here. Okay, so we'll look at the performance. So you can see the numbers are somewhat lower than what they were for the growth fund. This number is actually lower than the S&P 500. It's also lower than the category, which makes me wonder why it's ranked high, but I don't know. I'm not going to. And the key thing here is just looking at what the kind of investments that they have. So again, it's mostly stocks. It is mostly stocks. They actually have a fair amount of cash, even more cash. And let's look at some of the companies. So you've got General Mills, Hartford, Coca-Cola, Procter & Gamble, Campbell's Soup. So you see most of them are not technology companies. They're just manufacturers or food companies. So things that have been around for quite a long time. And they probably have dividends, and that's, these are probably companies that are known to have reasonably stable stock prices or improving stock prices, but their dividends are enough because some people want to take the dividends and use that for income for their lifestyle or whatever it is. So instead of selling the stock, you keep the stock and you just use the dividends. So that's from a stock fund perspective. Those are kind of the contrasts. Two of the contrasts. It's not like there's all these different. Let's look at target date retirement. So what target date retirements are, let's try this one, TIAA Craft. You might have seen commercials for that. They usually sell stuff to teachers and okay, so let's look at the performance. So again, you can see that the numbers for this year at least are around 10%. For the category, it's about 7.64%, so it's doing better than the category. This is Morningstar, what is a mod target risk. I don't know what that means. Okay. The key thing here is the holdings. So you see they have a lot more diversification. So they are 26% domestic stocks, 12% foreign stocks, 45% bonds, domestic bonds, 10% foreign bonds. If you look at some of these target date retirement, well, before we do that, let's look at what they have. They actually they invest in mutual funds. So they diversify. A mutual fund is already diversified into different companies. Then what these target funds is buy mutual funds that are diversified as well. So they've got some in growth and income, short-term bonds, large cap value, large cap growth. So they're spreading their risk over a lot of different categories and a lot of different companies. So it's even more diversified. And it gets close, the more you diversify, the closer you get to an index fund to some extent. Which an index fund just basically invests in everything that's in a certain category. And you don't look at specific stock or companies, you just invest in everybody and hope the whole market moves up. A lot of these, I don't see one yet. Let me just type it in here. If you put in the year 2035, in the year 2530, okay. The year is the target date that you're going to retire. And what they do is they change the balance of stocks versus bonds. As you get closer to your retirement, a larger percentage of the investments are in bonds and lesser in stocks. So 2035, that's almost 20 years. So it's for people who are probably about mid-40s would buy this target fund. And you can see the stocks is about 80% of the funds. The bonds are only 12%, and foreign bonds. So it's about 20% bonds, close to 80% stocks. You can see it in the pie chart here as well. That's because you're investing this for 20 years down the road. So you can tolerate some volatility. What you want is the highest return over that 20 years. It probably does. That's a lot of foreign stock, isn't it? It's heavy on the foreign stocks. Let's see if they go down here. Yeah. So let's look at a 2015 fund. So it doesn't actually have to be the year that you retire. It just depends upon what you want the balance between stocks and bonds to be. And if you stay in the same year target, as you get closer to that year, it will shift the allocation of assets to be more bonds and less stocks as you get older. So this is 2015, which means you're probably already retired. And in that case, you got 42% domestic bonds, 7%. So you're about half bonds and about half stocks. And if you had a 2005, you would even buy more bonds. And the whole concept is that when you get older, you've got less years to live. You can't as easily ignore the ups and downs in the stock market, so you invest in something that is more stable, like bonds. And remember, bonds are basically loans to companies. We're not buying part of the company, we're loaning money to a company. Yeah, I don't know what others is. Yeah, I know. You know, you can buy, there are funds that are like environmentally friendly funds. You can buy funds, then you can buy stocks that are, you know, have certain, you know, they won't invest in certain companies that do things that you don't like. You know, they wouldn't invest in cigarette companies or maybe military stuff. You know, there's even ones that are specific to that. So there's a whole bunch of choices out there. It's like going to a mall. So how do you make a decision on what the heck you're going to do? Well, typically, let's go on here to this next page. When you have to make those decisions, for most people, it's in the context of investing in one of these different tax-deferred strategies. So you've got traditional IRAs, you've got Roth IRAs, you've got 401ks, and you might have a 529 plan. So originally, I think it was the IRA came out. And the IRA, which stands for Individual Retirement Account, you could put in a certain amount per year, and the money that you put into that account was not taxable at the time that you put the investment in. So you got to put more in there, and then each year when you gained value, that value wasn't taxed. You were taxed when you took the money out when you retired. So ultimately, the government does get some tax, but not quite as much as they would if you put it in a non-tax deferred investment. The next thing I think was probably 401ks, which were can be sponsored through a company, and they're really the same as a traditional IRA. The income is tax is deferred. The building of the value is not taxable while it's building, but you do pay the tax when you pull it out. And the 529 plan is just the same as a 401k, but it's for not companies. So like a school, you can have a 529 plan. So they're pretty much the same. There might be some slight differences, but not that significant. So at this point, when you put money into these accounts, whether it's through a bank or somewhere else as a traditional IRA or as a 401k, you've got to decide what you're going to invest in. And the good thing, a good and bad thing, the good thing is they don't give you 5,000 choices. They typically give you maybe 10 or 20 choices, and there might be they'll probably give you a couple of retirement target date funds. That's reasonably new. They might say there's a growth. They might say there's a growth fund and an income fund, or just different kinds of mutual funds that represent the different kinds of strategies. And it probably is through one company that they hopefully have chosen because it's rated well, not because they get a kickback or something like that. But so you have to make some choices, but they're not daunting choices as far as the number is concerned. The Roth IRA is not through the company. The Roth IRA, you're taxed on it when you buy it, but you're not taxed on it with the accumulating value, and you're not taxed on it when you take it out because you've already paid tax on it. So I did a spreadsheet of that too because I was curious about it. And hopefully one thing you're gathering from me doing some spreadsheet stuff here is it's not rocket science. It's just doing some basic calculations. And a lot of these nowadays, you probably can find them online, but I did them myself just because I wanted to. And so I had this Roth versus traditional IRA. I did this at home because I was trying to decide, they always, what you hear nowadays is, oh yeah, Roth's better than a traditional IRA. And I never really understood what the heck they were talking about. So what I did was I took this theoretical $10,000, which seems to be a common theme, and I was going to put it in for 30 years. So I'm not adding it every year. I'm just putting it in one time, and then I'm seeing what happens with it. And I assume some interest rate, 8%. And then I have the tax rate when I'm working and the tax rate when I'm retiring. So in this case, I'm actually making more money when I retire, which everybody should hope for, but it may not happen. Or I may be making, less when I retire because I don't have a job anymore, but I have Social Security and other things. So probably for lower middle class, this might be a more. It's probably not 30%, but it may be this direction, where you're paying a higher tax rate when you're working than when you retire. And if you go down to the bottom, this is the traditional IRA. This is the Roth IRA. Notice the traditional IRA, I'm putting in the $10,000 and I get to use all of that money because I don't have to pay tax on it. Here, I'm paying 30% tax on that money, so I only get $7,000 of it. $3,000 goes to the government right away. When I get to the end, I have these amounts. This amount for the Roth IRA, I've already paid tax on, so I don't have to. I just take the money. For the traditional IRA, I haven't paid tax on it yet, so I pay my current tax rate, which is lower than when I was working. So if you have a lower tax rate when you're retired, then it's better to do a traditional IRA. If I go up here and do the opposite, if I'm really thrifty and I find out, hey, I'm actually going to make more money as a retired person than I was when I was working because I delayed gratification and all that kind of stuff. You go down here and it flips the other way. It's better to do a Roth IRA if that's the case. And so if a lot of people who are probably upper middle class, that's their situation. They're able to save enough money and they work for a company that has a pension plan, et cetera, et cetera. They may actually be making more money when they retire than when they're not retired. So that Roth IRA is a good deal there. If you expect to be in the same tax rate for both cases, 15% or any percentage, you come down at the end of the day, they're the same. So the Roth versus the traditional is all based upon what you expect. How do you predict that? What your tax rate is as a retired person. So what I would do, I've got some in Roth and some in traditional. The year that I'm taking out, it's not going to be taxable as a Roth. So, I could do one year, one the other year, and depending upon, what my total income is, to try to minimize the amount of tax I pay. Change my tax bracket for each year to maximize it. This number over here is if I didn't defer the tax. So I just pay the tax on it initially, and I pay tax every year on the amount that I'm gaining in value. So the bottom line there is that this number is always less than these numbers. So it's always advantageous to do either a Roth IRA or a traditional IRA, but there is a difference between the two depending upon what you expect. Will I be able, if I'm not somebody who saves a lot of money, the traditional IRA is probably better because I'm probably going to have a lower income when I retire. If I'm somebody who's a real good saver, then a Roth IRA may be the better way to go. And if you're just kind of a normal person, it probably doesn't make a whole lot of difference from the amount of money that you gain. There are a few other cases, a few other differences. Roth IRA, for a traditional IRA, you have to start taking out money when you're 70 and a half years old. So you can leave it in there till 70 and a half, but you can't leave it until you die and then leave it to your kids. You have to start taking some of that money. So for example, my mother, she had a traditional IRA. I think it was originally a 401k, and she ended up having to take a percentage of that out every year. It's called a minimum required distribution, I think, and it was based on her expected lifespan. So if you're 75, there's the data says you probably are going to live on average to be 87, so you have to take 1/12 of the amount out. Yeah, they wanted to empty it out by the time you die. Now she died with some money still left in there, which you're going to end up with some money left in there. So then if you get that willed to you as an IRA, I have to take out a certain amount per year based upon my life expectancy. So it's about 5% right now. So that means my life expectancy is about 20 years. So that's about 80 something. Okay. And it's not based on my health conditions, it's just based on averages. So as I get older, I'll have less money in there, but then I'll take out a larger percentage because my lifespan prediction is different. So that's one thing about a traditional IRA. You have to start taking it out at 70.5, and then at that age, your average maybe 15 years to live, so you take out 1/15 of that, and then well, then they'll have to rethink it. Now, Roth IRA, you don't have to do that. You can just keep leaving it in there. There's no minimum required distribution. So again, if you are wealthy and you have a lot of money, you already have money through other stuff, you might be using this Roth IRA to leave to your kids, and then they don't have. They can leave it to their kids. Yeah. So it has more tax advantages as far as inheritance. Yeah, I don't know what happened there. Let me come back again. There's some other small differences, but I think those are the main ones that I know about. So Carol, if you're listening, you probably know more about this side. You can tell me if there's some other issues involved with that. Okay. So what's the 1-minute piece of advice here for me that I think is push the wrong button there. And it's not that I did everything I'm saying here. I would have done things somewhat differently if I was better informed when I was doing this at a younger age. But if your company has a IRA program, a 401k program, save as much as they'll match you 100%. Then invest in a diverse a diversity of options. I have most of my stuff that I still have my money from Westvaco. It's still managed by the same company that does Westvaco stuff. I haven't pulled it out. And I have all of my money invested in a target fund. And the reason I did that was because I didn't have to worry about reallocating my assets as I got closer to, I'm lazy, and so it reallocates my assets as I get closer to retirement instead of me having to do that. And secondly, as you saw, the target funds are collections of mutual funds, so it tends to diversify you even more. So that's probably the most conservative approach and the one that requires the least amount of work. And most people are not wanting to spend a lot of time on this kind of thing. Yeah, what is that? That's drugs and marijuana farms or something. Yeah. So here's a little comment about keeping your cool. So this is the effects of fear and greed on investing. So this is showing the volatility that we talked about. And these are comments people make. So what happens is people have the stock market's going up, and they're like, they've waited 2 years, like, oh, it's been going for 2 years, so now I'm going to buy because I feel confident that things are going to be great. So, oh, we're seeing record profits, I'm buying. Well, then something happens that's unforeseen, or maybe should have been foreseen, but we kind of ignore them. And so the stock price starts to drop, and they're like, a little bit. And they're like, okay, I'm going to be calm. Nicholson told me to be calm. So I'm going to hold on to these stocks because it'll come back up probably in a day or two. And then it continues to go down, and then it gets to this point, and like, oh, the world's, I should never listen to that guy. He didn't know what the heck he was talking about. I'm selling my stocks because it's probably going to go down to zero, and I'm not going to have any money at all. Oh my God, that's the panic phase. That's my wife. And this is me saying, don't sell it right now. Okay, hold on. So some people would sell at this point, which means they lost the money that from here to here. Yeah. So then the smart investor says, hey, I'm going to buy the stock at this point because I know all the dumb people have gotten rid of it. So then the person sold the stock, and they're like, oh, I don't want to ever invest in the stock market again. Oh, hey, it's gone up again. Oh, I should have kept the stock. I'm an idiot. I should have listened to Nicholson. He was right. But I don't know. It could go down again. I've just gone through this terrible experience. I don't want to do this anymore. So I'm not going to buy anything yet. And then you come up and there's, oh, I'm getting ready to buy, and then you see a small drip. Oh, but it's going to happen again. Oh my God, I'm still not going to buy this stock. It's just terrible. And so they finally get the confidence back, and they say, hey, okay, it's been 3 years of going up, so okay, I have trust in the stock market again. So you buy it again, and then this happens. Okay, right? So that's why if you buy stock, through the company, if you're investing in a 401k every pay period, you will end up buying at the low point because you're buying it all the time. And if you buy it at the low points, you're going to get that advantage. You're going to, over the long term, it's going to be the better thing to do, but it's very difficult to do. It's against some of your instincts, and that's why if you save it and you put it into something that's reasonable, not risky, not some brother saying, hey, I got this stock tip and it's going to be great. If you diversify, over the long run, you'll do better. And if you don't do better, the whole country is going to be in collapse anyway. So there'll be people out with, trying to dig for food anyway. So you're going to be. It's not like you're going to be by yourself. Right. Yeah. So you just kind of have to go along with it and not get freaked out. And hopefully, over the long run, you'll either do well or the country will collapse. So we're hoping it's the first one. Yeah, that's right. So, okay, so that's it for today. I don't have any homework for this section. So there was for section 4, but there's no section 5 homework. So we'll just say a few more things about this next time, and then we'll move on to the algebra review.